All right. So we're going to move that just a little bit. All right. Hello, good morning. I am Shelley Simpson of Small and Mighty Marketing. I specialize in social media for small business. I am also a proud GSDBA board member, and I am here to give you some tips, but not me actually, Lacy Italiano, who is here.
Hello, thank you for having me.
Lacy is also a proud GSDBA board member, and at our Friday morning business networking group today, it was all about the new tax bill. So what we thought is that we should do a little Facebook Live so that we can answer the questions of all the members out there. Granted, it hasn't actually been given, all of the tax bill and all of its little pieces hasn't been, sprinkled down into all of the tax people and the accountants and stuff. But she will answer your questions live, so add them in the comments. And bear with us a little bit. It's our first one, so if there's some technical difficulties, just, leave a comment or watch, and we hope you find good stuff. All right. Our first question is about the personal exemptions are no longer allowed. And our question, it was actually me who asked it, and I was like, well, what does that mean? What does it mean that a personal exemption is no longer allowed? So I'm going to let Lacy answer the question.
When you're doing your tax returns currently, and as I think we all possibly understand, the new tax reform is not going to affect your 2017 tax filing. This is only for 2018. So nothing is going to change for this year as you're getting prepared right now to go in and see your tax advisor and get your taxes prepared. Every year up until 2018, we have had a personal exemption of, it goes up about $50 every year. In 2017, it's $4,050. That is something that comes off of your gross income in helping you get to your taxable income figure. It is also figured in with a standard deduction. And in the new tax reform, that $4,050 that you get for yourself, in some cases your spouse, dependents, is now going away. And in turn, the standard deduction has been increased and in some cases almost doubled. So while it will help some people, it could negatively impact other people, and you'll need to do some tax planning this year to figure out where you're going to be at now with the removal of those exemptions and the increase of the standard deduction. Also, the tax tables are changing because that exemption has been removed, and the IRS just released yesterday the new tax tables, and employers and payroll companies will now be transitioning to those new rates. You may see more money in your paycheck. That doesn't necessarily mean when it comes to filing your taxes that you're going to have a tax break. So it's imperative that you do planning with a professional so that you know that this new increase in your paycheck isn't going to be a balanced owed once you file your 2018 taxes in 2019.
All right. Is there something else that people ask you all the time about the new tax bill?
Another huge question I'm getting, and it's completely broad and open-ended, is, so I heard that I can not deduct any business expenses. So if you're a sole proprietor and you file a Schedule C because you have a small business, the new tax bill does not mean that you cannot take ordinary and necessary business expenses. That is not in the bill at all. You will still be able to take anything that is ordinary and necessary for you to run your business. There are some limitations now on the meals and entertainment. I know some people would buy season passes to the Padres season, or in the past, the Chargers, and then give those out to their clients. That will no longer be allowed come 2018. On the flip side of that, there is going to be a new up to a 20% credit that you can take off a net income for small businesses. It's very complex, and there's lots of rules about who qualifies and who doesn't, but it could be very beneficial to a lot of you small business entrepreneurs out there. And it is imperative to sit down with a professional to see what you can do to maximize that benefit, because it is out there now. It is a good aspect of the tax reform.
Can you see the comments? Okay.
Yes.
So I'm going to ask one. What's a good question? What about else that you found interesting or relevant to maybe solo entrepreneurs?
Well, that's a good question. I'm still learning, obviously, about all the new tax reform, and I will have a plethora of information come January 22nd when I go to my annual update. As a professional, we are constantly getting new education and learning as these things are changing. As we all know, the bill was passed, and now it's up to the IRS and other taxing authorities to be able to set up the right procedures to implement these changes. There is a chance that some of them could possibly not work. One huge thing for us in the state of California is, and San Diego specifically, is that the SALT, which is state and local income tax, which includes your property taxes and the state income taxes you pay, is limited to a maximum of $10,000. I have several clients, and even including myself, that pay, well over that in property taxes, let alone including your state and income tax. So there could be some negative effects for those of us that live in a higher state income tax state and have higher property values. You would very easily pay over $10,000, and that's now being capped. Mortgage interest is now being capped at a acquisition debt, meaning you purchase your house and you'll only be able to deduct interest off of $750,000 of acquisition debt. You can no longer deduct the interest off of your equity lines of credit. That is going away. You will not be able to do that. And so I know there's plenty of people in San Diego and Southern California that have mortgages of well over $750,000. You will no longer be able to deduct interest above and beyond that amount. Again, that is something that could negatively affect a lot of people in our area. I can.
You can just read it, so read the question.
How should a small business set up her business, LLC, S Corp, etc.? What's the difference, and how do they influence taxes? That is a sit-down type of question. There is basic liability coverage for setting up an LLC and an S Corp, or being just a sole proprietor. It's an individual basis. There's advantages and disadvantages of each. It's going to depend on the type of business, your gross receipts that you pull in from the business, what you may need in terms of employees or benefits. So that is an individually based question that you should sit down with a tax professional with, so that they can get a whole idea of what it is your business needs and what is the proper entity to set up. In California, it's important to discuss that prior to setting up the entity, because the state of California, you have to pay a minimum of $800 a year to set up a separate entity, such as an LLC or an S corporation. So a lot of people will set up an entity not realizing what the requirements are for it, and then not necessarily be making the money they want to be, but still on the hook to pay the Franchise Tax Board for having that entity running in the state of California. So I would suggest sitting down with a professional and giving them your personal situation so you can best decide the entity that will fit you and your business.
Nice. I don't have any other questions. Can you talk about the property tax? There's something about property taxes.
I just did.
Oh, you did?
Yeah.
Sorry. Sorry.
That's okay.
That's right, because you folded it into those.
Here's some other big ones that are disappearing deductions, other than the state and property taxes being capped at $10,000 a year. Moving expenses. So if you move for a job, you used to be able to deduct those expenses if they were not reimbursed by a employer. Unless you are certain military, you will not be able to deduct moving expenses anymore. So that's a big one. Employee business expenses. You used to be able to deduct certain expenses that were not reimbursed by employers: mileage, travel, entertainment, home office expense, union dues, tax preparation fees. All of those are going away. They used to sit in a box on your miscellaneous itemized deductions, subject to 2% of your adjusted gross income. So while a lot of the population really did not benefit from deducting things like their tax preparation fees, and they won't see an effect on that, there are some people that did deduct unreimbursed employee expenses. that will no longer be allowed. That has been completely taken off effective 2018. We did go over the mortgage interest and the fact that equity debt interest will no longer be deductible. Some good things about the bill that have passed are the medical expense has now been temporarily adjusted back down to 7.5%. A lot of people may or may not meet and exceed that and be able to benefit from taking medical expenses. A huge one for me is AMT. The threshold has been increased, so fewer middle class people will be affected by it. AMT is a very complex tax that comes into play when you make over a certain amount of money. It was never really raised for inflation. It was something that was passed in the 70s. And a lot of people that live in states like California, cities like San Diego, that make a six-figure income, and perhaps their spouse does too, would very often get hit with AMT, and then their deductions would be disallowed in addition to this alternative minimum tax. Now the thresholds are finally being raised, and that is a huge step. The estate tax exclusion has nearly doubled to $10 million, and the annual gift tax exclusion will stay the same at $14,000, but the maximum rate on gifts is 35%. I think we may all know that the rates have changed. We still have 6 tax brackets. The maximum now, instead of being 39%, will be 37%, and the corporate rate is now going to be a flat 21%. Also, a huge thing is there is an increase in the child tax credit. It's now going from $1,000 to $2,000, and $1,400 of that is refundable. And for some people that have maybe a parent that's a dependent or a non-child dependent, whether it be maybe a mother, a father, a cousin, somebody that's living with you that you provide more than 50% of the support for, and they are not your child but are still dependent upon you, you could possibly receive a credit of up to $500. So that's something that's going to be new and hopefully help with any negative effects from not having the personal exemption. So we do have a new question. What are 3 to 5 things that business owners should keep in mind all year in regards to taxes? Well,
go to CPA.
Definitely sit down with a professional. That's always important. Everybody's situation is different, and this is something that is very individualized, and it takes sitting down with somebody and knowing all the different aspects of you individually, your finances, your business. If you are an entrepreneur, it's important to have somebody that you can sit down and talk with before you make decisions, because oftentimes it costs more time and money to undo something that could have been prevented if you had a simple consultation. Your deductions for business expenses are not going away, so please still keep your receipts. Always try to have implemented a QuickBooks system or computerized accounting system that will help you see where you're at, estimated payments, or for sole proprietors, LLCs, or reasonable compensation for S corporations. There are a lot of people out there that are single shareholder S corporations, and there is an IRS requirement to have reasonable compensation, and that does get missed a lot. And it's huge if you get audited. Those are some small things, but it's always important to do your research and sit down with a professional that can help you with a more individualized plan. And that is something I really like to do, working with the small business community. And I'm always more than willing to offer a free consultation. So please, if you have questions, definitely ask before instead of after.
All right, so we don't have any more questions. We're just going to hold out for a second to see if anybody joins and asks some more questions. And if not, we're ever so grateful for Lacy's time. And we're going to do more of these, so if you're a GSDBA member, contact me. I'm Shelly at smallandmightymarketing.com, and I'm happy to feature you. And thank you.
Thank you, Shelly.
You're welcome. All right, so again, this is going to be stored in our little video thing, so if you need to see it later in a second, you can see it then. All right, thanks. Bye.